So, hello everyone. My name is Vikas Agrawal, and I'm the founder of AIF and PMS Experts India. So, we are sort of emerging as one of the largest platform for investing in alternate investments and portfolio management services. And if you wish to know more about it, you can visit aifpms.com and you get to know all the details. So, at AIF and PMS Experts India, at this platform, what we essentially do is to sort of educate and empower the investor community, and we keep organizing these knowledge-based sessions every week. In fact, in last 3 years, we had more than 150 webinars that we already organized, and as a result of that, more than 239,000 people have viewed our YouTube channels and attended these webinars and taken the benefit of the markets. So what we do is we invite industry experts, and therefore we call this show as Ask the Expert Show. So we invite them and read their mind. So with me, I have very special guest, Mr. Aman Chowhan, with me. So so Aman doesn't need any introduction. Well, a lot of people know, but maybe those who have joined here for the first time, for their benefit, let me have the privilege of introducing Aman. So Aman brings about more than 2 decades of experience when it comes to equity investing, and out of 2 decades, which is about 22 years, he has worked with Mr. Sunil Singhania, who happens to be the founder of Abakkus and chief investment officer. He has spent more than 1 decade, close to 13 years. So there is a saying that if you keep on working with someone for more than 10 years, 12, 13 long years, you sort of get synchronized with the thought process in terms of, what you want to do. So there, 1 plus 1 doesn't become 2, it becomes 11, because then the other person of your team member what kind of thought process that you all bring on the table. So, well, Mr. Sunil Singhania himself is an institution, and then Aman working with him and bringing about all the expertise on the table. I was very much sure that only a miracle would happen in terms of delivering the performance. Well, I'm not over exaggerating things, but thankfully, I'm very happy to share that ever since Abacus has started its journey in India, it has sort of outperforming most of the portfolio managers. And of course, followed by the benchmark, respective benchmark. So with that, we'll start the conversation, and the topic is very much clear that today we'll try and read Aman's mind about markets. We'll understand more about markets. So Aman, firstly, thank you so much for accepting our request and taking the time out and joining this call for the benefit of our investors.
Sure. Pleasure is mine, Vikas. Thanks for the great introduction and happy to be on the call with you.
Right. So Aman, if you can talk to us about, because as a house now, you're managing more than $1 billion, both put together, AIF and PMS. So first thing I want to understand is, what are your views on the markets? Because we saw last 3 months, 4 months, particularly FII is turning back in India, and this is what you mentioned during our last conversation that we had 6 months back. I still remember, and those numbers you talked about, that how FDI is participating, and while FIIs are returning back, and you also categorically mentioned that there'll be time when these FIIs will come back to India and start investing, which is FPIs these days they're called. So your what's your views on markets as a house?
Mm. Uh, just a small correction before we start. So now we are managing close to $2 billion of AUM between our AIF and PMS. And coming to markets, yeah, it's been a tear since 31st March, I remember, was the bottom of the market, and since then, market has not looked back. So April, May, June, July, 4 months back to back. It's been a great recovery for the markets. And the way we look at this market right now, the first thing is it's not just that India has performed, it has been a global rally, and India has participated in this rally. And yeah, we have obviously outperformed the way we did last year also. So before we come to the current market, let's take a step back and let's see the calendar year 22. This was the year where, after almost a decade, global investors lost money both in equity as well as in bond markets. Nasdaq was down, there was correction in Dow Jones, and rates went up, and the bond portfolio also suffered. This was a period when Indian markets were flat. So after a great run post-COVID, we had a flattish 12, 15 months, and we were not very happy about it. It's a flat market. But on a relative basis, we are the best performing markets. Other markets were down anywhere between 30 to 40%, and we were flat. So that was the background. This scenario continued for the few months, Jan, Feb, March, and then from April onwards, global markets also started to move up. Now, what triggered this? Uh, I think the trigger point came in the way central banks handled the CSFB as well as the regional banking crisis. So we had two large crises, one in US, one in Europe, and both the central banks were quick, fast enough to come, act, and resolve and diffuse this crisis within a week to 10 days time. Both these events, I think, gave the confidence to equity investors that the central bank is there. If something goes wrong, they will similarly come and act, and hence we can get aggressive. So the common word that is getting used globally is which is a risk on and risk off. So we were on a risk off mode, and once these two events got handled, we got into a uh, risk on mode. So this scenario started from April onward, and it was a global rally in which India also participated, and that is something is what is getting reflected here. Obviously the mid and small caps did much well, and that rally continues, and globally also the rally continues. As we speak, Apple is at a new high. The popular FANG stocks in US are all up anywhere from 50 to 100 from their current lows, and the backdrop to this rally was that interest rates are close to peaking out. So that scenario has been there for the last 6 months. So the people were just waiting for something positive to happen, because all were saying that yeah, interest rates are going to pause very soon, and then once inflation stabilizes, we'll also start to see rate cuts, which is something which the equity investors like. So people were waiting. This event got triggered, and we had a global rally. So obviously, India is doing well on a global term. We are among the fastest growing large economy, and the way we did relatively better when they were down and we were flat. Now, when they are rising, we have risen along with them, and maybe we have risen better than many other markets. And that's what is getting reflected in the new highs that the market is hitting. So this is the setup. Now, how long this will continue? What's the reason behind this? Is there something to be scared about because we are at a new high? Is valuation something too high? And what one needs to do? Uh, we feel that there is no local event, or at least local known event, which can spook this market. Because domestically, we are fine. There is small amount of slowdown in the rural market in the bottom of the pyramid because of the inflation, but otherwise government is doing fine. Any of the government data that we look at, whether it is GST collection, highways, infrastructure creation, tax collection, everything is at a high, and we have a pretty pragmatic government at place, and that's what is getting reflected in the numbers also. So bearing the small, you can say rural slowdown, things are pretty fine. The fears of an El Nino for monsoon is also receded. We have got above normal rains so far, and there is no reason to believe that not to believe that the rains would not be normal this year, and that is also something which is good for Indian markets. So locally, doesn't seem to be any reason why the market will get spooked, and hence any correction in the market, if at all it happens, it we feel it will be more due to global events than local events. Now, globally, what can go wrong? Nobody knows. Every week there is a data which comes out of the US. Any data can surprise on the negative, and markets can get into a profit booking mode or a sideways time correction or a small correction also. That's possible. If that has to happen, then I believe Indian markets will also follow. But here also we'll have a relative outperformance. So, say for example, if the US markets were to correct by 5%, we might correct by 1 or 2%. Or if they correct by 10% for any reason, we might correct by 5, 6%. So there will be relative outperformance, but we will follow the global trends is what we feel. We are not going to get decoupled the way we got it last year for a few months. That doesn't seem to be the scenario right now, because we have got decent liquidity in the last 4 months. As you were mentioning the last call, I had mentioned that global investors doesn't have much of choice to invest. So once they start to investing, they don't. They are definitely going to come back to India, and that is what we have seen. So from outflows, we are seeing good amount of inflows coming in the last 4 months, and domestic liquidity was always there. So a combination of both domestic liquidity and FI inflows have resulted in the rally that we have seen, and this can continue. This can continue, and at valuations we are close to 19, 20 times FY25 earnings. So I'll not say we are cheap. Definitely we are not. Are we Expensive, no. We are 10% premium to the 10-year average. In the past, we also gone to 25 multiples also. So that is also something which is possible, especially in a falling interest rate scenario. And when China is slowing and India is growing, that can also be a scenario which can come in. So we can't rule that out. But yeah, we are, can say, fairly valued, a slight premium, and this can sustain depending on the backdrop that we are into. So it's not that one it should be very scary that okay, sell equities and run away kind of a scenario. But from here on, one should expect only rational returns. The kind of returns you have made in the last 3, 4 years, especially post COVID, or the way last 4 month market has moved up, I don't expect a similar kind of number to come in the next 12 months. If it happens for any reason, we are all happy. But at least that should not be the expectation. Otherwise, you might get disappointed. If you come in with a rational return expectation, then Indian equity markets can easily deliver. Now, one needs to also keep this one thing in mind that there are going to be elections. So, what today market people discuss that Modi is going to get re-elected next year, June, July is going to be election. Until that time, there is no worry, and Modi is coming back. So that's what the market view is. There is one small, or you can say minor uh, precursor to this, which is going to happen in November and December, where MP, Chhattisgarh, and Punjab Rajasthan, MP, Chhattisgarh, and Rajasthan, all these states will go for state elections. Now, that could happen that Modi might lose popularity at the state level, and then this can have some impact on the markets. So there will be a sentiment dampener, and people will start discussing that okay, Modi is losing popularity the way we saw it happening in the south. People will start extrapolating this. So after this is something which is significant because after UP and Bihar, these three states have the maximum number of seats for BJP. See, BJP is not very prominent in South, right? So they have to garner the maximum seat from the North and from the Central India. South is not something that they are very strong at. And if they start losing the Central India state elections, then people will have some doubt. So right now, the market view is very clear that Modi is coming back. He might not come back with a 300, 350 seat kind of a scenario the way it happened last year, but they'll still get a clear majority. If that is the scenario, then people are still happy. If there is any sentiment dampener to that, then markets will react negatively. So one needs to be careful for this event. In November, December, there is going to be state elections. So it's not just that next year central elections is something that is going to matter. In the inter-state elections will also have a news flow impact on the markets. Bearing this, I don't think there's not much to worry about. Things are getting better. Export demand is slow, but we are gaining market share at the expense of China. So the China plus one strategy is doing working well for us. Domestic manufacturing has picked up. Government has clearly identified sectors and segments where it wants to focus. The PLI scheme is working. So things which were slogans a few years back are now getting visible at the ground reality. Almost 25% of iPhone 14s, which were sold globally, are now made in India. And we never realized when this happened. Foxconn already is in India. They already taken land, machinery aa gayi. People have got employed and shipment bhi ho gaya and it has got sold also. So
जो
that's the
पहले
way
चाइना
things
से
have moved.
होता था अभी वो इंडिया से हो रहा है.
Exactly. The earlier iPhone 13, everything was China. iPhone 14, 25% is India. And I believe in the subsequent years, they want to increase this 25% to even a higher number. So we are doing well from that perspective. And uh, not much of options for a global guy to invest either way. If I have to see, look around. Sri Lanka is bust. China, nobody wants to increase the exposure because of the government intervention there. Pakistan is worst. Bangladesh is not in a great shape. Greece, Portugal, Turkey, hyperinflation. Russia event is not over yet. In UK, every 6, 9 months there is a political turmoil and then there is a new PM that keeps on coming in. Commodity-driven economies like Indonesia, Brazil, they are also decelerating because commodity prices are off the highs. So there's not much of option. So for a global guy, if he has to invest, what are the options he has? Maybe a Philippines or a Thailand or a Malaysia kind of economy, and within that, India stands out as a large economy, underpenetrated, growing well, decent positive demographics, and a decent government in place. So this is where the whole setup is, and hence India seems to be well placed to participate in this global rally. So till the time the global rally continues, I feel that in equities also will do well. And relative basis as well as absolute basis, we should be doing well is what the market view and market call would be.
Okay. Great. So you don't see any major trigger as such in the near future.
At
Having said
least
that,
locally nahi hai. Yeah.
yeah. But having said that, you talked about state elections which are going to come, and it can have some amount of impact depending upon the results, what kind of results we get.
Yeah.
So Aman, I want to read your mind and understand how are your funds positioned now. Any presentation that you wish to run, or and how are you deploying funds now? Let's say the fresh money. Let's say I get I give you a mandate of 50 lakhs to start with. You're deploying right now completely. You're waiting for some time because I saw that post Ukraine war, you're the only portfolio manager in India was conscious, very conscious about deploying money and took some cash call also during that time. So over to you.
Sure. So we don't take cash calls per se, but yeah, definitely we take time to deploy money. So if we don't have a standard model portfolio that I receive money on Monday and Tuesday based on that model portfolio, I'll deploy the money. I invest only and only when I feel the risk reward equation is favorable. Else, I tend to take time to build my portfolio. So today, if a new client has to come in, and if the client has to come in either of my two PMS, which is one is the all cap, which is a combination of large cap and mid caps, and another one is a dedicated mid and small cap, he would be in a week's time getting deployed anywhere between 70 to 75%. The balance 25% we intend to deploy over the next 2 to 3 months. So that's broadly what it is. So nobody is getting fully deployed. The guy who came to us 6 months back, he is 90% plus deployed. Somebody who has been with us for more than a year, they're all 95% deployed. So there's no cash calls per se, but yeah, for a new guy, we are not just blindly because market has rallied quite sharp in the last 4 months. So we just don't want to blindly go and deploy the full amount. So he will be 70-75% kind of deployed.
Okay. Now, particularly mid and small cap, we saw, inching up a lot in terms of valuations, and the P that we talked about is for the broad markets. But what's your sense about mid and small cap?
So the way we look at valuations, it is not that large caps have a separate valuation and mid caps have a separate valuation. It is more to do with sectors. So there are some sectors where valuation is higher than other sectors, and within each sector there are some companies which are very highly priced, and there are some companies that are still available at a decent valuation. So it is not a broad canvas that all mid caps are high priced or all mid caps are low priced or at a low P. But clearly, in the last 4 months, mid and small cap has seen a sharper rally than the broad markets. So, depending on which company it is, most of the stocks are anywhere from 50 to 100, 200. In fact, some stocks even more than doubled in the last 3 months. So, uh, one needs to be careful about that. But overall, I see that mid cap valuations also selectively depend on the sector. Say, for example, financials. Now, we like the financial space, but within that, we are pretty positive on microfinance. We are pretty positive on housing finance kind of thing. So in housing finance also, the leading company in housing finance would be trading at 2 times book. The number two guy is trading at 1.2 times book. So there's also a relative valuation gap between the number one and the number two player. If you go to number three, it's trading at 1 time book. Or say microfinance, we have a good exposure in microfinance. They're still trading at 1.5 time book, where most of the banks are now trading around 2 times book. So there is still a good relative valuation gap between company to company. So one needs to be pretty selective. That's what we do. So we invest with a clear bottoms-up approach. There is no benchmark investing that we do. And wherever we see value, both on an absolute as well as on a relative basis, is where we are adding to our exposure.
When you talked about sector and specifically, you also mentioned about companies and their valuation. So, and generally, these are the questions that I keep getting. So, I'm asking you on behalf of our investors. So, do you think going ahead, what's your first of all churning ratio? Churning ratio includes, of course, you changing the weightages also. So, I'm not talking about that. I'm talking about the number of and new companies entering and going out. And do you see it is going up as we move ahead and the volatility will go up?
So if you have to ask me churn ratio based on the new companies entering and exiting, then it is in single digit. So it is less than 10% of the churn ratio. So we churn predominantly for two reasons. One, if the stock has moved too fast and too ahead, then we would like to book some profit and use that money somewhere else. Or if we feel that the company is not performing for a certain reason, it could be a macro reason, it could be a global reason, it could be a micro reason. For whatever reason the company is not performing, we have a 6 to 9 months review period. In that time, if you feel that the company might continue to under deliver, then it's better to bite the bullet and get out of that storm. So these are the two scenarios where we exit a holding, and then that cash gets used to get into a new name in the portfolio. But doing this, I feel it's a single digit churn ratio, because the fact of the matter is, while the market is 18 to 20 times earnings, my portfolios are still trading at 15, 16 times, and with 20% plus earnings growth. So I'm pretty comfortable with the portfolio that I have, both from the earnings growth perspective as well as from the valuation perspective. And hence, I don't foresee a big amount of churn to happen in the market. So anyway, we don't take cash calls. Tomorrow, if the market continues to rise, we might book some profits and get into some new names. But that, as I mentioned, should still be within single digits.
Yeah. The other thing is, I remember, Aman, when markets were coming off from COVID fever, you were always away from specialty chemicals. I mean, you had some, but then you felt that the valuations were high and you intentionally came out, or it was just by default that, it just happened.
Uh, no, it was very clear intentional call that we don't want to pay a super high premium just because some sector is in the limelight. So we don't want to blindly chase momentum. So that's the philosophy that we follow. That we invest only when the risk reward equation is favorable, and we have a very clear view that a great company need not necessarily be a great investment. See, a great company will become a great investment if you buy it at the right price. HDFC is a great company, no doubt about that. But is it a great investment? Only time will tell, right? It has been a great investment, but from here on, it has not. Last 2 years, HDFC Bank is flat. ICICI Bank is more than doubled, kind of scenario, right? So you always have to be pretty careful about that. That is the reason we follow the value conscious style of investing. So while we are not a pure value investor that I'll just go buy and buy a 5p stock or a 10p stock, but at the same time, I don't want to pay a 70, 80p to a company which is growing at 10, 15%. So I don't mind paying a 25p for a 25% growing company, or even a 30p, but definitely not a 70, 80p. So what was happening in specialty chemicals was that only the market was in the frenzy in this sector. These companies were growing decently well, 15, 20, 25% for some company, but trading in north of 40, 50p, which we were not very comfortable with. And that is the reason consciously we stayed away from that sector. We got into bulk chemicals, we got into other chemical names, but not the specialty chemicals at 50, 60p.
Right. The other thing is, Aman, as we move ahead, there would be a possibility, the way we are growing, that the market may migrate from this historical P of 18, 19, 20 ka P to 24, 25 ka P. It can happen, right? As we move ahead, as the valuation goes up. Do you think that your framework would also allow you to be on that side, because you're very, very value conscious? And suppose that everything is around that range, how would you deal with that situation?
Sure. So valuations are two fronts. One is an absolute valuation, and one is a relative valuation, right? So on an absolute valuation basis, we are pretty comfortable paying a peg of 1.5 kind of thing. So if the company is going at 30, I don't mind paying a 30p or even a 40, 45p, but not beyond 50. Then there is also relative valuations. So as you know, market is an art. It's not a science. We are not running a quant model. The peg ratio 1 है तो ले लो, peg ratio 1.5 होगा तो बेच दो, kind of a scenario, right? So we have to take a very stock specific call upon that. If everything in the market is 25p, then even 20p is a relatively better valuation to get into. Everything goes to 50p, I can't be sitting on cash then, because my mandate is to be staying invested in the market. We are not running a long short fund. We're not running a hedge fund that we'll take a call that now 40p is too expensive. Cash call, le lo, cash mein baith jao. That's not what we do. So it's a combination of both absolute as well as relative valuation. So tomorrow, for example, say markets were to move and get into the 25p zone, my portfolio, I believe, will be under in the 20p zone. So endeavor will always be that my portfolio valuation should be lower than what the broad market valuation is.
Right. The other thing is, Aman, this you talked about this, new themes which are emerging in India, like Apple contributing 25% of their new manufacturing phones coming from India, going abroad. But how do you play that? I mean, these are, and we saw particularly last 2 years, 3 years, we saw a lot of FDI money coming in India, and as a result of that, those businesses are shaping up and now up and running and exporting. So, how do you play these new themes in your portfolio?
So wherever there's a new theme or new sector, if you don't catch it early, then the valuation gets completely haywire, which is right now happening. So if somebody has to capture the manufacturing theme or the assembly team. Then there are companies like Dixon and uh, PG Electroplast and the likes of that, and they all trade north of 50 PE, right? So we like this sector, we like the opportunity, they'll do well, but at 50 PE, maybe I'm not very keen to get into. For some reason, tomorrow, if I get the same company at the 30, 35 P, I'm definitely ready to look at it because this is something which is a sunrise sector. The sector will do well, companies will do well. Same thing, you can indirectly participate via a capital goods company, which is making electrical equipment, which is making electrical parts, which is making compressors, or which is making turbines, which is making cables, wires, transformers, right? So the all whenever there's a capex, whenever there's a spending, it is not just the big guys benefit, the smaller guys benefit even more because ultimately the big guys source from the smaller companies, the smaller components, which ultimately gets assembled into a plant. So there are lots of ancillaries which is there in the manufacturing space. I feel this is also a very good way to capitalize on the manufacturing upside that the India is seeing.
Yeah. So maybe last couple of questions. So if you have any questions, dear audience, please type in your questions in Q&A box. So couple of last questions, Aman. So which are the two, three sectors you think, according to the backers, you guys are bullish on, or you think that the new India which is shaping up, these sectors will have a major contribution coming?
So right now, we are pretty positive on financials. That's something which is one of the largest sector holdings for us, and we continue to be positive. For a simple fact that most of the banks and the NBFCs have come out of the COVID period very fine, right? So there not been much of damage, not much of NPAs that has come in, and hence the balance sheet is quite healthy. GDP growth in India is expected to accelerate. There cannot be a GDP growth without the banking sector participating. So if you want to grow, the banking sector has to participate, whether it is capex, whether it is working capital, whether it is whatever kind of requirement here, the banking will see a credit growth. And that's the reason we are pretty positive in financials. Besides financials, we are also positive on metals. With China opening up, we feel gradually the demand will start to pull up, and with the coal and other raw material prices getting softening, this is one segment that we are positive as we speak. Pharma is also something which is interesting, but one needs to be very selective in pharma. So if you're a raw material consumer or if you're importing raw material, then you're doing well. If you are exporting raw material to the world, then you're not doing well because the China's supplies already started to come in, and you can see prices softening across the board. So some companies are clear beneficiary of this in the pharma space. That is what we are very keenly looking at, and we have invested into a few pharma names also. Besides this, consumer durables is looking good. Last 1 year, demand has been soft because of the high inflation that I was mentioning. As we get into the festive season and with a good monsoon coming in, I expect this sector to start picking up. Plus, we'll get into the election mode. So typically, we have seen that 6 to 9 months ahead of the elections, there's a good amount of demand pickup which happens into the rural market and to the consumer discretionary names and consumer durable names. And this is the reason we are also looking at this sector pretty favorably.
I remember last year you stopped taking money in your fund. So now that the valuations are again coming back and the size has also gone up, you think that you continue to manage without any problem at the moment, or you feel there is a concern?
Obviously, valuations are not as attractive as what it was a year back. So from that way, there is a challenge, and then you have to then start looking at new companies, and that is what we are pretty comfortable doing. So we have a large investment team, almost 15-member investment team, and the research team reports into me and to Sunil, and we read annual report, we speak to management, we generate our own ideas. So we are not dependent on market brokers to give ideas to us. So because of that, we keep on getting new ideas and new stocks keep on getting into the portfolio. So you can say that yeah, the stocks in my portfolio or the market favorite stocks have gone up, but there are still many undiscovered stocks. There are still many stocks where the market fancy is yet to come in, where the market is yet to look into it, and there are opportunities. I'll not say that we are full or we are struggling to get new ideas and we're thinking of closing subscription. No, we are not, at least in right now, that's not what we are discussing at all.
Assuming that I have 50 lakhs to allocate, Which one you think, Aman? I mean, just a valuation point of view. I'm not telling you to do asset allocation. Which one you think makes sense for me? Should I go for the all cap, which is your multi cap approach, which is large and mid cap predominantly, or emerging opportunities, which is mid and small cap?
So if valuation is the only criteria to select, then the mid and small cap fund has a lower valuation versus the all cap fund. So if there is no asset allocation call to be made, just on a pure P basis or PEG basis, mid and small cap fund has a better valuation, a better relative valuation than the all cap fund.
A couple of questions which has come up. So first question, do you focus on dividend paying stocks?
No, that's not the focus area for us. So we'll not buy a company just because it has a high dividend payout. So for us, earnings growth, quality of the management, and sustainability of this earnings growth is something more important than the dividend yield in the company.
Second question is, what would prompt you to sell a stock?
As I mentioned, two reasons. One, if the stock has moved too fast, too ahead, and we feel the valuation that it is currently trading is too high, and I have better alternatives with me, then it is better for me to switch. So sell this stock and buy a new stock. So that is the one scenario when I would sell a stock. Second is if the company is not performing. So I invest in say company X with the expectation that there will be a certain amount of profit growth, there will be a certain amount of you can say turnaround, or there is a certain amount of triggers in the stock. If those triggers or earnings don't materialize, then you have to bite the bullet, sell the stock, and move on and get into a new name. So
Next,
this would be two scenarios where I would be selling stocks.
the next question is, should we choose your AIF or PMS? Let me answer this question first, and then I
Yeah.
would request Aman to add up. So it purely depends on you, like what's your investment horizon? Because when you are investing in AIF, first of all, the minimum threshold is 1 crore. And for PMS, the minimum threshold is 50 lakhs. So when you are investing in AIF, you need to look at that it comes with its own time horizon. So the minimum time frame any AIF manufacturer would have it at least 4 years or 5 years. So depending upon your time horizon and depending upon like in PMS, it is open ended. Like after 1 year, you can take out the money. So liquidity plays an important role. But Aman, do you think at the investment philosophy level, do you see any other changes amongst both the vehicles?
No, from a philosophy standpoint, there is no change. So it's the same team which handles both the AF and the PMS, and the strategy is also similar. There can be small differences because, say, for example, IPOs. IPOs I can invest only via my AF. I can't invest via my PMS. Or a QIP. QIP is only for my fund, not for my PMS. From that perspective, some stocks will be figuring in the AF and some different stocks will be figuring in the PMS. But besides this, there is nothing different. There is the same philosophy, the same style, is the same team which handles both the fund as well as the PMS.
But Cat 3 AIF does give you some flexibility to invest companies when they are not listed at a private equity level. So at Abakkus, do you believe that exercising this option ever?
We have that option. We haven't exercised that it so far, so we don't have not invested into private company. We have selectively invested into pre-IPO deals when the IPO is just a week, 10 days, or a month away. That is the time we would have taken some exposure, but not in the unlisted space, and nor do we intend to do that.
Next question is, what risk are you currently hedging against?
So there is no clear hedging policy that we have because this is not a long short fund, this is a long only fund, and we invest with a 3 to 4 year investment horizon. So at the current high levels where the market is and where the market has rallied in the last 4 months very sharply, I am not very aggressive in this market. So if I have, as I mentioned, if I get fresh cash, I'll not be completely deploying it in one shot. So I'll be gradually deploying that money over the next 2 months or so. So that is one precaution that we are taking. And on the valuation side, we are not getting carried away. Like for last 6 months, defense stocks have done well, PSU stocks have done well. We don't have any defense or PSU stock in the portfolio because we don't want to chase momentum. This is something that we are not very comfortable just because it is rising. I just don't want to get into. So this is also one of the precautions that we are taking, that not lose the discipline. Let's not get carried away. Stick to the style, stick to the philosophy, keep continuing things that we are good at, and have the 3 to 4 years of investment horizon in whatever we do.
Great. So with that, we'd like to conclude the session here, Aman. It was pleasure talking to you. A lot of insights from you about markets and the outlook. And we wish you all the very best and keep up the good work and continue to beat the benchmark.
Sure. Thanks, Vikas. Thanks for inviting me. And any queries, anything on our products, feel free to get in touch with our team, and we'll be happy to help.
Thank you. Thanks.
Thank you.
Okay. Thanks, everyone. If you have any questions, please reach out to my team at aifpms.com and we'll give you all the information with regards to Abakkus PMS. Thank you.